Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Theo Chapsalis, Giovanni Zanni, and Jan Nevruzi. Before getting into the discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they're available. All right, we've got so much to discuss this week. It was a super volatile week. So let's get straight into it. We're recording this on Thursday afternoon, straight after the ECB. So I think it makes the most sense to start there with you, Giovanni. So we've had quite big market moves. I think the market took that as quite a hawkish ECB meeting. Is that your interpretation too, or do you think that that was wrong?
Well, my interpretation is that it was, well, not hawkish, no, definitely not hawkish, but let's say clumsily dovish. Because she said the right things, right? She said, inflation was still seen as transitory, that higher energy prices can actually lead to problems to disposable income and thus to demand and to inflation, depressing inflation in the medium term. And then in terms of market pricing, she said that it wasn't consistent with the forward guidance of the ECB, that they were not expecting rates to be lifted off in 2022, not even 2023. So, I mean, all the elements were there. It's just that she was probably not forceful enough. She said things like, not for me to say in terms of market pricing, which again sounds a little bit like not the right thing to say in this situation. And also maybe the fact that growth is seen to be quite robust, and the fact that it wasn't in the statement, took off a little bit of the dovishness that otherwise was there.
What about on inflation? I mean, that's obviously been like the hot topic of the moment, is whether this is transitory or less transitory than we first thought. What did we really learn about their kind of view of inflation going forwards?
Well, I think that their analysis is very similar to my analysis of inflation, at least in the euro area. So it's in between the very short-term, temporary, and the permanent or structural or persistent. It's just that it's going to last for a bit longer. This is what she said, and I definitely agree with that. Because it's a combination of energy prices, and we know that they're there for at least another few months. Supply chains, again, this is what their surveys and our surveys are saying about the fact that they will last a bit longer into 2022, and then the temporary effects that are going to be moving out of the equation already earlier next year. So, if you take everything together, I think their analysis is very realistic, consistent, and the message of saying it's still temporary, but it's going to last a bit longer into 2022 is perfectly fair.
I mean, for kind of global central banks, the big debate over the past few weeks has been about rate hikes and the timing of liftoff. But for the ECB, I guess the more pressing matter is really around QE and what happens beyond March. Did we learn anything more about that today, or is that really a question for December and beyond?
It's my understanding is that the only thing we really had was this kind of much more explicit idea that PEP will end in March. That was clear. The rest, frankly, she vaguely mentioned something about flexibility, and this is the debate that we're having inside our team, as you know perfectly well, but more broadly. But I don't think that she gave out a lot, and December was and still is the meeting where we expect not just their decision, but also announcement and clarification for the markets.
All right, thanks, Giovanni. I mean, I don't have a huge amount to add from a markets perspective. I think, like you said, the market took it more hawkishly than we would have done. I think ultimately we will be guided by ECB rhetoric over, well, maybe even over the coming days, but weeks and months back towards their current forward guidance, and therefore we continue to think that market pricing is too aggressive, and that will be pushed back later out beyond 2022 and probably beyond 2023. I guess one of the other interesting things that we saw on the market side was this kind of continued flattening of 530s or 1030s, which had already taken place as it was being driven, in part by the UK's budget yesterday, and we can talk about that, Theo, later. But for the ECB, it really is more about QE first and rate hikes, and if we're going to get to a point of rate hikes, then we first have to be thinking about a drop down in the pace of purchases, and that really is a steepener more than anything else, we think. So I would expect that those rate hikes can be pushed back further out the curve and 1030s to steepen up again. So I guess that brings me nicely onto the UK then, Theo. An even more volatile week in the UK than it has been in Europe. The UK in many ways has been leading the way. Let's start with the budget yesterday. Like I said, we're recording this on Thursday, so we had the budget yesterday, which I guess surprised markets given the kind of size of the market reaction. But what were they surprised by? What is the kind of key takeaway there that markets weren't expecting?
I think the most significant surprise came from the CGNCR, so the central government net cash requirement, which is a number which basically shows how much the government needs to borrow. Now, this becomes very relevant because it is the key number for gilt issuance. That number was revised lower by 83 billion, and it came similarly to our expectations, so the expectations that Ross Walker had. But it was really below the market. What is particularly interesting is that we deal with a 58 billion reduction in gilts and a 25 billion reduction in T-bills. Now, the DMO had to take a very important decision, which was we need to cut financing, we need to cut issuance. We have 100 billion to issue. How do we reduce issuance? And well, the fact that the DMO had to reduce the stock of bills shows that they had to take such a difficult decision, because you change the amount of bills only in a tough environment. They could not deliver all the reduction through less gilts. Imagine what would have happened. Well, a much more of a flattening. So what we got yesterday, and this is really, as you alluded to before, the significant flattening which is made in the UK. And this comes from the monetary policy angle originally, but yesterday that got reinforced by the fiscal angle, fiscal meaning by the DMO angle. So we have a significant cut in gilts in general. DBO1 in the market is not what it used to be. A lot less longs as well, other than less shorts, which is significant. The DMO deliberately allowed a significant number of linker issuance, and this is key. This is why the view that we had towards wider break-evens has faced some headwinds, simply because, well, conventionals outperformed in this case. But I think what stands out and what I keep out of everything as of yesterday was resounding gilt strength, especially relative to other markets, simply because it was the most oversold market. And now we enter a phase where just the availability of gilts will be a lot smaller than what it used to be.
So it's a busy couple of weeks in the UK, because not only did we have the budget yesterday, but we obviously have the Bank of England next week in this kind of flurry of central bank meetings. So does the budget have any implications for your expectations next week?
I think it creates, it makes the meeting next week a lot more important, in the sense of right now there is clear bid for duration, and APF QE is an absorber of duration. As things stand, QE is expected to last until mid of December. Now, if QE was to be stopped, we talk about 20-something billion of gilts that will not be invested as part of QE. So to us, this is 34 million a basis point. It's big money, whether that gets reinvested or not, or to be fair, not reinvested, whether that gets invested is the right word or not in terms of gilts. So there are a lot of thoughts from investors, or that maybe there is a case for the BOE and there is more impetus for the BOE to stop QE. But paragraph 65 of the minutes clearly states that rate rises can happen while QE takes place. So this is something very important. The other point that we make is that QE can continue, and it would make sense to continue in order to show commitment, in order to show that the central bank indicates something and they do deliver, they stick to their word. We understand that the BOE, they did not like forward guidance so much, and this is why they changed their forward guidance narrative in recent meetings. We get that, but now, do you really need to stop a program for just 1 month, a program that you initiated, last year, and you're so invested in the idea and you're so invested in your credibility for the future?
So you mentioned paragraph 65 then, around the sequencing and the fact that rate hikes can occur while net QE is still ongoing. So I guess that's the big debate at the moment in the UK is there going to be a rate hike next week? Which side of the coin do you fall on that debate?
Oh, this is a very difficult question, because it is it is a coin toss. I mean, usually strategists, we need to have a clear view and a very strong view. We argue for no hike. So we argue for a hike to be delivered at the February meeting. In terms of views, we think that the market pricing ahead of the December meeting is quite high. So the market prices in almost 50 basis points by December. So this is quite substantial. Could there be a hike at the November meeting? It depends on, I guess, on the discussion and on the influencing skills of different members. But as things stand, we think that no hike happens next week. The first hike is delivered in February, then in May, and then in November of 2022.
All right, thank you. I didn't mean to put you on the spot there. I guess my last question would be, if we do get a hike next week, a 15 basis point hike, or actually I've got two questions. If we do get a hike next week, do you think they just deliver the 15 basis points, or do they go the full way for 40 basis points to get them back on that quarter point schedule?
Yeah, fantastic. And this is actually quite a key question. I think they should deliver 15. I think they will deliver 15. So the way that we operate, or the way that the BOE operates, is that there is a discussion, and then the governor comes up with a proposition, and there is a vote on the proposition. The proposition is on the bank rate. The proposition is also on QE, but that's a separate proposition on the stock of QE. So we will have a proposition on the bank rate, and then members vote. Now, it makes a lot more sense to have a proposition for 15 basis points. We do not think that there is such a strong consensus that the proposition would be really 40 basis points. And also, if some members do support the 40 basis points, they would at least want to see those 15 basis points being passed rather than just risking the 40 basis points not being delivered. So we think that it's going to be 15 basis points if it is a rate hike.
Okay, that makes sense. And then my other question was, so you have 15 bips in by February, and then another 25 basis point hikes. So that's 65 basis points by the end of 2022. So if we do get a hike next week, 15 basis points, does that change your rate profile? Do you think we could see an additional hike in 2022, or is that just bringing forwards the February hike to November, i.e. we don't get any higher than 65 basis points by the end of 2022?
We think that this is more a matter of timing. So it is just delivering the hikes sooner rather than later. It remains to be seen whether the BOE expect the terminal rate to be higher than in the past and higher than otherwise. The market prices in a terminal rate at around 1%. At stress conditions that we had seen this week, we've seen some forwards being in the 140, 150 area. So clearly, under stress conditions, the market may price some rates, some forwards being higher. But we think that this will require additional work from the BOE. And mind that the BOE, and the main reason why they they shifted their narrative and they moved the non-reinvestment of gilts from 1.5% that used to be in the past to 0.5% is simply because they realize that we are in a world of lower yields, and also that the whole distribution has changed, i.e. negative rates are also a possibility in the UK now. And hence they do see that also the terminal rate will be probably lower than otherwise. So it is a matter of timing. If we are to have more hikes, we need to see a clear word from the BOE that they find that the terminal rate is indeed higher than what they signaled previously.
Okay, great. Thank you, Theo. Lots to look out for in the UK there. All right, last but not least then, we also have the Fed next week. Are we expecting, well, I should say, what are we expecting? This was pitched previously as the kind of taper announcement meeting. Is that still on the cards?
Yeah, that's definitely on the cards. I don't think there has been anything that changed the dynamic in a way to justify pushing back tapering. The previous minutes showed that the committee was sort of split between November and December. But I think market consensus has come to a point where, we certainly expect November to be the announcement. Chairman Powell was out there giving some speeches saying that November is just implying that November is the right time to start tapering. So I don't think there's anything that should change it. And I think it has been well communicated. Market had enough time to digest, and it shouldn't really cause, if it's delivered, it shouldn't cause any ripples. And just as a reminder, we expect announcement in November, which means they start reducing purchases in November, 10 billion in treasuries and 5 billion in MBS at each month. Rather, that's kind of where we changed a little bit of our mind. Prior, we used to think that it would be more so announced on a meeting by meeting basis. So that would mean, it would be on average on like a month and a half. Now we think on a monthly basis, it's sort of going to be automated with, of course, some footnotes there saying that they have the ability to adjust it. But initially, we think it's going to start in a kind of almost autopilot-like phase and go through June. The last month of net purchases would be in May, so end in June.
What about on the QE side? Not the QE side, the rate side. Sorry, we updated our forecast this week for rate hikes, didn't we?
We did. Now we see the first hike for Q4 2022, and that's just it really is coming to terms with the fact that inflation is going to run much higher than previously expected. The uncertainty around inflation is going to be high, and even with the Fed framework, the Fed probably would be unwilling to tolerate a PCE that runs close to 3% next year even. So at that point, we think the Fed will have to react. So our call is now for a first hike in by end of next year, so in Q4 2022, and 4 additional hikes, so 1 per quarter in 2023, bringing for a 5 total by the end of 2023. And as far as market pricing goes, our 1 hike is still below where market sees what the Fed will deliver next year. However, into 2023, by end of when I checked this morning, the last pricing showed something like 4.8 hikes priced in by the end of 2023. So we're pretty much in line, if not slightly more bearish over the next 2 years when it comes to Fed's reaction function.
I guess that goes to what Theo was saying, that it's more about a question of timing rather than the kind of ultimate level of rates when we get there. So it's not all about the Fed next week, though, because we also get the refunding announcement, right? Actually, on the same day as the Fed. So you're going to be very busy on Wednesday. So what are we expecting? Well, I guess what are we expecting in terms of the issuance outlook for the next few months?
Mm-hmm. So this refunding for a change is likely to bring cuts in coupon auction sizes until, for the last almost 2 years now, it's been increases and increases, and now we're gonna start the beginning of a cutting cycle, just because Treasury, with the current coupon issuance rate, is so overfunded, even with some more pessimistic deficit scenarios. Just for reference, we have our deficit forecast for fiscal year 2022 at 1.5 trillion. To contrast that with the current net coupon issuance rate, get a net issuance rate for coupons without redemptions runs at like 2.5 trillion. So that leaves a big gap of overfunding that Treasury doesn't need, even accounting for accounting for the funds that are needed to bring the Treasury General account to comfortable levels. Something like 800 billion is what we assume. So what we think we're going to see is cuts across all lines, but more weight to be placed on 7s and 20s. 7s just because they really ramped up issuance there, and 20s just because it has been an underperformer. It's cheap on pretty much any metric that you want to look at. So I think, and Treasury has communicated in the Treasury Borrowing Advisory Committee member recommendation also was sort of in line with, we should probably do overweight cuts in 20s. And after that was made, I think it's became market consensus that we will get larger cuts in the 20 area. So 7s and 20s being the overweight cuts, it's hard to still make an exact prediction for bills because it's going to be really dependent on the debt ceiling and how fast it resolves, how quickly Treasury has to replenish cash balances, how much cash is left in the account before the debt ceiling problem is fixed. But again, we think something around like 500 billion on net added, let's say from December onwards, just to replenish the bill stock a little bit, keep it in the around 17%, so between the 15 to 20% recommended range. So that's pretty much it. And finally, in TIPS auction sizes, we're likely we'll see continued increases. So say like another billion per line, as they've communicated well, just because A, the share of TIPS as outstanding debt has fallen a lot, and B, they kind of have made it clear, so there's no reason to deviate from that path now.
In terms of the cuts to coupon issuance, what kind of size of auctions are you expecting, or what size of reduction are you expecting? I guess across the curve, but then also specifically for 7s and 20s, where are you expecting it to be overweighted? Yeah,
so overall across when in fiscal year 2022, when we finish all the reductions, just like a top line figure, we see about 800 billion of nominal coupon reductions in fiscal year 2022 compared to 2021. As far as on a line-by-line basis goes, we expect to see 2 billion of cuts in 2s, 3s, and 5s each month, 3 billion in 7s, 10s, and 20s for new issue or reopening, and per month on the 7s, and 2 billion for 30s. So that, when we take into account the duration factor, the 20s, the 3 billion in 20s is a significantly larger reduction compared to what we would see in the 2 billion in the 30s. Similar to the 70s, 7-year. 3 billion a month, it's going to bring down the size a decent amount. I think about like August, after the August refunding next year, they should be close to or pre-COVID levels if they go with our pace, our expected pace.
Fairly sizable cuts then, really, versus
which should be actually sort of coincidentally, like you said, it's in the same day as the Fed announcement of tapering. So over the next year, the flows don't exactly offset each other, but just from a supply and demand perspective, it should be similar amounts that what the Fed pulls from the demand side, Treasury should also reduce from the supply side. Of course, there's other kind of market. There's these like, it's not equal 1-for-1 as Treasury issues the newest ones while the Fed buys across like a spectrum of bonds, but still.
How coincidental. Yeah. All right. Thank you very much, Jan, and thank you, everyone. I think that's probably all we've got time for this week. But just a reminder to our listeners that if you like today's episode, please don't forget to click like and hit subscribe so you can get our latest episodes as soon as they're available. Thanks, everyone. Speak next week.